right, welcome back. This is Justin Humphreys again. Objection to the form. Today's episode is going to be focused on residential real estate and residential mortgages. And one of the things I wanted to talk about was an issue that comes up a lot, which is wiring money. So, believe it or not, attorneys are one of the biggest marks for wire fraud and scams, and it takes on all kinds of forms. And the crooks are fairly sophisticated and creative, and they change the way they do it. But the most common one is they hack your email. And so somebody, wire fraud criminal or somebody, hacks into the attorney's email, and then they're able to find out that a closing is coming up. And so from that point forward, they know, they see the email correspondence, and they determine who's involved in the transaction. And where they move from next is they mask the attorney's email address. So a lot of times it'll be, if it's maybe a dot .cm instead of .com, or they'll do a minor change that you don't recognize. And where they do from that is they'll send the scammer will send an email over from wait a minute, it's Ben Hawkins just walked in the studio. I was in the middle of talking about wire fraud, and it was wire fraud. It's not a fun topic.
It's funny you bring that up.
You had some scammers coming after you.
Well, we're actually not allowed as mortgage lenders. By the way, hi everybody. Ben Hawkins, as Justin just said. Love coming on his show. I haven't done it yet, actually. What am I talking about? I'm loving it so far. But hey, I just wanted to talk about that. So with wire fraud, as a mortgage lender, we're not allowed to give out wiring instructions. So every client that we have actually will contact you directly, Justin, and get the wiring instructions from you. So that way we stay out of it. No security fraud. No nothing going on there.
I was kind of explaining the way it typically shakes out is the masked email, where they change a letter or something in the email address, and then all of a sudden there's a last minute change when it's, I know you were planning on an email it to this law firm, but we've switched bank accounts or something like that at the last minute. We try to give people the heads up about that on the front end, but I would say that's something to watch out for. Anytime you get some kind of last minute, we've changed our bank accounts. Changing bank accounts is a huge hassle. I've done it twice since having the firm open, and it's just a disaster. So it's not something that you want to get up. You know what? I think I'll switch banks. I like this, but it's not. It'd have to be a really big deal to change bank accounts. So anyway, that's the way it works. The other thing I would say to people is get familiar with how to wire your funds yourself.
Absolutely.
A lot of times people say, well, we wire the proceeds to the people when they sell property, and they'll say, we'll ask them, how do you want it? They say they want to wire. Like, all right, well, do you have your wiring instructions? Well, here's my check.
Right.
And that's kind of a frustrating thing, because the check, many lenders use a separate ABA number to accept wires and distribute them, and it's like half do, half don't.
Well, let me ask you this, Justin, because this is something that came up today that we've got a bunch of closings going on over the next maybe next 2 months, actually.
This whole COVID thing has been a blur.
Right. But we've got a ton of closings with you guys. Is my point. Your office is my go-to. I mean, you all do a fantastic job, and I'm not saying that because I'm on your show. It's the truth of the matter. We spend a long time in the Lynn with Ben show talking about that too. But my question for you is this: a lot of folks will ask me if they have to bring, say, they have to bring $500 to closing.
Yep.
Hey, Ben, can I bring a personal check? Or if, say, they have to bring $5,000 to closing, can I bring a certified check? What is the cutoff amount that you guys require to wire over, like, set amount?
So we do $5,000.
Okay.
And that's because it's a North Carolina State Bar regulation as far as dispersing from your trust account. Now, different offices do it different ways. I've seen 1,000. I've seen 3,000. I try to keep it as high as possible, just because it can be, a lot of people have these online banks.
Right.
And they can't go into the office and wire, and don't have the ability to wire through their online software.
Right.
And we've had certain situations where people get in a jam because they've just assumed that doing the wire would be nothing to it. And then it comes to the day that the cash to close is ready, and then they're kind of at a loss because
to be clear, they have to wire. It's a state bar law that they have to wire over $5,000. Now, say I only have to bring $4,000 at closing. What does that mean then?
Well, let me back up. It's not a state bar law that if it's over $5,000, it has to be a wire. But in order for the law firm to disperse same day.
Got it.
So that's what
Okay.
it is. So yeah, I don't want you can. I mean, I've got some people will give me a lot of cash buyers. They'll just cut a check, well in advance. or that's things of that nature. Or if it's, refis, sometimes I'll just, and they're bringing a substantial amount, but it's not going to close for 3 or 4 days later because of the rescission. They'll just hand me a personal check and we'll wait for it that way.
See, I've got a client that's actually closing tomorrow that's bringing like 7,200 to the table. And they asked me about that, and it's a refinance. The reason they're doing that is because obviously this time of year the collection escrows. Yeah. So you guys, in theory, if they brought a personal check on the day of signing tomorrow, it would give you all time to make sure the funds are available by depositing the check, and they could just write you a personal check instead of having to wire and go to all that trouble.
That's correct.
Awesome.
It's just a dispersing same day issue.
Got it.
And that's where, because we're not allowed to disperse from the trust account, unless we have that. And we've got buffers built in.
So below five, like if I have to bring $4,000, would you guys tell me to go get a certified check if I didn't have the?
We prefer to do that,
Okay.
especially if it's a one-off closing or somebody we've never met before, done business before. We'd prefer to have it certified.
Right.
I only had 1 or 2 checks bounce, and we've had good luck with it, but it's still, you never want your trust account to have an issue, like you thought funds were going to be there and something ended up happening. So we always prefer certified, especially if they're looking to record the next day. I won't disperse on a personal check.
So anything under 5,000, they can bring a certified check within reason, and then the same day disbursement. Correct. Anything over that, if it needs to be wired in. I got you. That's great information, because I get asked that question a lot, and I refer to you guys, but now I can save you a phone call and just and give them the answer.
Yeah, under 5. Yeah, that's the reason that works the way it does. And for a while, you used to be able to take certified funds as cash.
Right.
When I first got started, some of the lenders would attend the closing and bring a check and kind of would make a show out of it and be like, here's the check, and we do that, but we can't do that anymore because of the we can't disperse out of the account if it's same day, because there were some scams going on with people have gotten good at creating fake certified checks.
Right.
So that's been good, but
a couple bad apples spoil it for the whole bunch.
That's right,
Justin.
That's right. Well, we're gonna cut to a break in a moment, and then we'll come back and talk about residential mortgages. All right, we're back. Subjection to the form. We got Ben Hawkins here. We're gonna get into detail a little bit about residential mortgages. And first of all, this probably sounds like a really stupid question. But I like to do the funnel method of, we'll start broad and we'll narrow it in. But what is a residential mortgage? And what I mean by that is, like, when you do a loan, whose money is it? Is it the bank's money, or is it federal money, or what is the money that's going out to pay for somebody's home?
That's a long answer to that question. Okay. I'll try to shorten it up as best I can. The abbreviated version. So it works differently with different lending institutions. If you deal with a mortgage broker, that particular broker will shop between 8, 9, 10 companies to try to find a place that can get their loan processed and get it closed in an efficient manner, but also to compete for interest rates. A retail lender like what I am, we lend our own money. So we're not a broker where we're shopping for somebody to lend the money to you. We offer our own interest rates, our own products, based on agency guidelines. So we're direct to Fannie, Freddie, and Ginnie Mae, which is FHA, VA, USDA, any government financing. Now, what happens is we are lending our own money, but we have investors on the secondary market that will purchase pools of loans. So if anybody tells you they're going to hold your mortgage, they very well may. There's a lot of companies out there with servicing lines that will hire sub-servicers. So say ABC mortgage company is holding the paper. Your loan is what I would call the paper, and ABC Mortgage holds it. Well, they may have XYZ as a sub-servicing company collecting your payments.
And that's what I was going to ask about. So, because I think most people kind of experience it as, where do I send, whoever I send the payments, or where I send the payments, that must be the owner of the loan.
Right.
And a lot of times I think that's not necessarily the case.
That's exactly correct. There's somebody behind the scenes, an investor that has that money on their books, but they hire a sub-servicer who they pay to go out and collect payments from the borrower. So that's one form of management they don't have to deal with, but they are the risk takers. Now, when we talk about does the government loan the money? No, the government doesn't loan the money. On VA, what they do on VA financing for our wonderful vets and active military out there, what they do is they guarantee the mortgage. They guarantee a certain percentage of that loan, that if the borrower, God forbid, defaults, that the VA or the government will then pay the lender. They guarantee the loan. FHA, they insure the loan against default. So it's different but same. And with conventional financing, I mean, there is no insurance other than mortgage insurance.
Yeah.
If you put down 20%, there is no insurance.
Well, and I want to take that kind of step by step. So then I got the servicers are the ones collecting the payments. Now, I imagine in a larger loan or like in a large bank, like maybe your Wells Fargo's or those entities of the world, I would suspect that they service their own loans. Is that?
In a lot of cases, Wells Fargo will be the one servicing their own paper, but I would submit to you that they have sub-servicers that are fall under their umbrella that are collecting those payments for them. Now, Wells Fargo, they are a big mortgage servicer, right? And during COVID-19, when it first hit, servicers were scared to death because of all the payment deferments and forbearance requests that they were going to receive. Who's going to front those payments, right? The servicers were scared they were going to have to do it. And it turns out, the government provided the relief or whatever to minimize that risk. But yeah, the Wells Fargo, you may get a mortgage statement from them, but there may be a sub-servicer that's collecting that on their behalf, but they still hold the paper. The payment ultimately funnels up to Wells Fargo if they own the note. So
does the sub-servicer bear the risk of collection? Because you were saying a lot of the servicers were concerned they were going to have to pay this. When you service a loan, do you make payments to the owner of the loan regardless of whether you collect or not?
If you're a servicer, you have to front payments to the investors. So as an example, I'm servicing my mortgage, but I have to front the payment each month because when you make a mortgage payment, when I pay my November 1st mortgage payment, I'm paying October's interest. You understand what I mean?
Yep.
So you go back in the rears a bit. So
the interest was paid on the front end by the servicer, and now they're collecting it.
Right. And so therefore, who's going to come up with the money, right? Like if everybody's in forbearance and deferment, and you've got 50 or 60% of all the loans that are serviced out there, the trillions of dollars in loans, who's going to get those? Who's going to collect those payments? Where's the money going to come from? Who's going to front those payments? But again, with the relief that came in, it really helped drive the market back down on the residential mortgage side to where it was stable. We saw interest rates, Justin, you're well aware, all of a sudden overnight when this COVID-19 stuff broke out, rates went up to like 5.5%, 5%. And I'm calling my management team like, what is going on here? Everybody was scared to death that had a servicing line or servicing portfolio or those companies that are buying those pools of mortgages that are sold on the secondary market. Everybody was pulling out of it because they were worthless.
So one of the things that I'm sure, and I think I've seen you, I always enjoy following your page on your pages on social media. But I think one of the things you and I've seen some other lenders that I follow had similar thoughts of when I guess you've got the bank-to-bank lending rate hit zero, and so I guess you get people calling up and they're like, I'd like to get in on one of these 0% loans now that the rate's been changed.
Right.
So I would suspect that it affects the rate on a residential mortgage, the prime or the bank to bank rate. But what exactly does that mean, the bank to bank rate?
So really that more or less impacts like credit cards and things like that. I mean, more of your revolving or even installment debt. On the mortgage side of things, I mean, yes, having a lower Fed interest rate is obviously a great thing. But it doesn't necessarily do anything. If the Fed lowered it less than 0%, it's not going to drive rates down that far. The thing is this. And here's what I want people to understand. We're grateful for everybody we have an opportunity to work with or lend money to. But here's the thing. We're about to loan folks $200,000, $300,000, $400,000, $1 million even. It's got to be profitable for somebody, right? You're not going to get a 0% interest rate because somebody wants to just give you money. I mean, if that were the case, sign me up for as much as I can get, right now.
Right.
So somebody's got to make money somewhere. The great thing about the Fed rate being zero, the bank-to-bank rate or what have you, is that money can move around in lower interest between those entities, and in turn it benefits the consumer. I mean, we're seeing historic lows, all-time lows, and I know that gets sounding cliche, but we're seeing it as a result of a culmination of all those factors and the 10-year Treasury bond. I mean, it's way down, but with inflation is something that we really got to watch out for coming up here real soon. If inflation hits us, and I know we don't get political on my show. I'm sure you probably don't on yours, Justin. I do loans for Democrats, Republicans, Independents, everybody. Yeah. But if this tax plan, I had Barry Habib on my show last Saturday. Barry is an industry-wide known guy. He has his own shows on, just CNBC, Fox News, the whole gamut. The thing that he was stressing is He looked at Biden's tax plan, and again, no disrespect to anybody. I don't care who you're voting for. Hey, you don't know who I'm voting for, right? But at the same token, these economists are looking at this saying this will be catastrophic for interest rates. It may drive them low for just a little while, but ultimately they're going to explode. Same with the economic markets. There's so many factors that go into play here, but inflation has been a big concern driving mortgage interest rates.
Yeah, and I've always understood that being the purpose of raising rates, because you think, why would you ever raise rates? And I guess it benefits the savers, and it benefits investors that are in T-bills and things of that nature. But I've heard that's a way to slow down inflation is by raising the rates. With this bank-to-bank rate or the Fed rate, so who's lending the money at 0%? Is it the U.S.? Is it the Treasury loaning it to banks, or who's getting in on the 0% loans?
Well, I mean, when you truly talk about zero, what does that mean, right? Who's really getting zero?
Yeah.
What it is it's a baseline marker for the way that they're going to sell back and forth to each other or lend money to each other on, okay? Ultimately, the Fed can loan money to these entities as well, and they're going to get the banks or whoever's getting the money is going to get a heck of a great deal on it. Right now, those savings are being passed on to consumers because, I mean, heck, anytime, who thought we've been talking about interest rates, not to get off subject with the bank to bank, but it's a direct result of a lot of those culmination of things. So when you have an interest rate, who'd have thought they'd have been in the high twos on a 30-year fixed or mid twos? I mean, it's insane. But hey, we also have a zero base rate. Here's the thing, though. I got a lot of calls, just like a lot of folks did. Hey, I saw the rates drop to 1% or whatever. I'm like, no, that's not where mortgage rates are. Companies have to be profitable at the end of the day. The bank-to-bank rate may be zero, but heck, you got to make money somewhere.
Well, ultimately, I would assume that the bank is selecting the rate where it's willing to lend. That it's, I mean, I'm sure you got to do what's competitive.
That's what I mean. You stay competitive in the market within reason, but also too, you have investors that you sell to on the secondary market that you hedge funds for, where they set their rates, and then you pad those on top of that with whatever that spread may be. We and I've always worked for places that were very customer minded and client oriented, to where the spreads aren't that big, and that's the thing that people need to remember. If you're getting loaned money $200,000 or $300,000, $400,000 on an interest rate in the mid to low or mid to high twos, I mean, if anybody has any complaints about that, I'd like to take you in a time machine back to when I first got in the business, even in 2005. Yeah. We were selling 7-8%. You go back to the 80s, it was 18%. You know what I mean? And those things are real. Those things, people remember that. I had a gentleman today I got pre-qualified did a pre-qualification for. He said his first interest rate in the 80s was 12%.
That's crazy.
And I quoted him 2.625 on a 30. I mean, it's just nuts. It's nuts, the difference. So, yes, do you benefit from it? Absolutely. The banks are still going to make their money somehow, right? I mean, that's just what's going to happen.
So you mentioned, I guess the bank-to-bank rate is a driver of it, but then you brought up the example of during COVID, how the rates spiked to 5 or 6% overnight, right. And I guess because of apprehension of the servicers saying, well, hold on, if we're having to front all this interest, we can't have a bunch of loans going out that aren't getting paid.
Exactly. I mean, they were scared they were going to have to continue to front the payments. Nobody knew how long these deferment things were going to go. I mean, think about if there was no relief package or no talk about what was going to happen to these servicers. Say these people were in forbearance or deferment for 6 months. That's 6 months worth of payments that somebody has to front. And say you have a $60 billion servicing line. I mean, the devastation behind that was almost catastrophic. We got very, very lucky that it didn't get worse than what it did.
What's happening with these deferments? Is it a situation? I've heard people kind of give warnings about, hey, if you get on deferment, you need to watch out because once your deferment's over, it's all going to be due. Does that mean, are they saying, all right, if you get deferred for 6 months, then you got to pay 7 months of payments on the 7th month? Or are they tacking it on to the back end?
See, that depends. It depends. It's servicer to servicer. It's company to company. Whoever's holding the paper, they get to call the shots on that. That's why we talked about on my show, and I talk about on social media, when all this stuff first started hitting, don't take deferment or forbearance unless you absolutely have to, because of the fact that what's going to happen is there's going to be some folks that on the back end of this thing, say 6 months, 12, well, we're already 6 months into it. Well, we're past it now. Say 12 months go by, and then all of a sudden, here comes a large chunk of change due for all the mortgage payments that you had in deferment. They're not putting it on the back end. Some companies aren't, and you're expected to pay it right then in full, or you will have a concurrent mortgage late.
So do you know that when you apply for your forbearance or deferment, do they say, all right, we're going to defer it, but it's all going to be due at the end, or do they make the call once it comes up?
It's supposed to be very clear. However, there was a situation, and I'll use an example. Before COVID, my parents 3 years ago, right? They after Hurricane Florence, they applied for a disaster assistance down here through Chase Bank, is who held their mortgage. Chase never told them that all that would be due. But my parents luckily were fortunate enough to be able to pay it when it came to. It was like 3 or 4 months is what they got. They didn't have to take it, but they did because of all the insurance costs. Their house got hit by a mini tornado. Yeah. So the reason I bring that up is this: they weren't told that they would owe it right then and there. But yet maybe they didn't ask the right questions. So many folks may not be asking the right questions or be aware that they need to be asking, and then they're going to get a heck of a surprise. The other thing, too, is if you're not able to pay that lump sum back at once, if they're not applying it to the back end of your loan when it's ultimately paid off and moving it to the rears, what will end up happening is, where was I going with this? If they don't back it up to the rears and it's due all at once and you can't pay it, you may make your monthly mortgage payment, but the problem is that you're going to have a 30-day late rolling every month. So that completely kills your credit score. It completely ruins your buying ability, and that's the biggest problem that we see. My parents actually got hit with a 30-day late on their mortgage 2 in a row because of that deferment thing that they weren't told about. And my mom was like, well, look, I never would have taken it if I'd known that.
If it's deferred.
Right. Yeah. Exactly. But the credit bureaus did the right thing. They went to the CFPB per my recommendation. Hey, look, here's the channels we need to take to get this removed. They've never not paid anybody. Yeah. I mean, they've always been stellar, and it was a drastic move for them because it dropped their score 60 points.
Oh, that's huge. I mean, well, I'm glad that I was able to get worked out from them because that just doesn't sound right.
But the reason I bring that example up is because it's still relevant to COVID as well. It's the same scenario. It's still payment deferment, just for a different reason. The reason they had it was because of a natural disaster. Yeah. This reason is because of a pandemic, and it's still being offered. But the same thing can happen to the people out there that my parents went through with the COVID stuff. So I pray that everybody out there that may have had a deferment or is in forbearance has got that straightened out, that they're not going to owe it all right at the end of that forbearance or deferment period, that it is going to, in fact, be put on the back end of the loan. And also, too, if they don't pay it all at once when it's up, that they're not going to get concurrent mortgage lates. You really got to be careful. That's why I told folks, don't take it if you don't have to.
Well, there's some more I want to get into about that, and then we're going to take a quick break, and then when we get back, I want to talk a little bit about late fees or concurrent lates, how that affects your credit, and then get into mortgage insurance a little bit.
Let's do it.
That I wanted to get into. I'd plan on jumping right into mortgage insurance, but you mentioned concurrent lates. So I presume that means back-to-back late payments.
Right. So there's when we look at credit, there's what are called trade lines, and a trade line is an individual piece of your credit. Your mortgage is going to show up as an individual trade line, but what we see are 30, 60, and 90-day lates. So here's the thing: when I talk about concurrent mortgage lates, sometimes like in deferment, if you didn't make your payment all at once at the end of it, or if you took deferment and they were going to ding your credit score a 30-day late each month because you're not officially caught up but you're making a payment, you're going to have a 30-day late in that regard. Now, if you go 2 months, you have a 60-day late, which is 2 30s in essence, but it counts as a 60, which is even worse. And then if you go 3 months, it's 90, and then beyond that, you better get ready for foreclosure proceedings and short sale offers and stuff like that. So to your point, a mortgage is late. Like, say my payment is due November the 1st, right? Yep. I have 15 days from November the 1st to make my mortgage payment. On November the 15th, it's technically late, and I could be assessed a percentage penalty of that payment amount as a late fee. Beyond that, if what I advise folks that we're refinancing right now is this: if we don't close by the 15th, that's okay. It's okay. You're not going to get hit with anything. But if you go over 30 days, you are going to get hit with a 30-day late. If you make up that payment, then it's still going to show on your credit. After 30 days, if you made a late payment, it's still going to show up on your credit report as a late payment, but you're not going to get like a rolling over 30-day late.
Well, yeah, and that's what I was wondering if there's a distinction between getting, missing 3 payments in a row and having 3 late fees, or if they just wait till 90 days to make the report. Is it the amount of days late that's the issue?
If you're 30 days late and we pull your credit and it's 30 days, we're going to see a 30-day late. If it's 60 days late, we're going to see a 60-day late. So it's not going to keep reporting 30, 30, 30, but you're going to see a 60-day late, which means that obviously it's back-to-back 30s. Yeah. Does that make sense? Yeah. It's just the way it reads on the credit report. There's different reports look different ways, but I mean the mortgage report we get, it's easy to tell what's going on there. Now, some folks are just consistently 30 days late, and here's the thing that here's really where that hurts, Justin. I mean, the low interest rates and everything right now, folks want to refinance. If you've had any mortgage lates in the last 12 months, you're going to have a heck of a time getting approved on any loan product, period. Even a streamlined product like FHA or VA interest rate reduction refinance loans, a VA IRRRL. I mean, they're gonna ding you for that.
Does FHA have a floor of if your credit's under this score, we're not touching you?
Actually, FHA, per guidelines, per agency guidelines, will go down to a 500 credit score.
Wow.
But the problem is typically people that have a 500 credit score, no disrespect to anybody. I'm sure everybody's had some bumps in the roads in their credit throughout their lifetime. No disrespect to anybody. But if your credit score is 500, chances are you haven't paid very many people anyway, or you've had a tough time. Maybe somebody got sick. Maybe you got sick. I mean, you've had a difficult time. So they can go down to 500. It's very hard to get an approved eligible, which is what we run in the automated underwriting system. Once we fill out your loan application, or in mortgage world, it's called a 1003. It's hard to get an AUS approval, automated underwriting approval, with a score below 580. It's really actually pretty difficult to get one with a score below 620. You better have some compensating factors like some assets or retirement funds in the bank to fall back upon, that we can show stability, that God forbid you can't make your mortgage payment. But anything, let me just finish with this, Justin, anything below a 580, you would have to have a manual underwrite, which is you'll need compensating factors like 12 months of VOR, verification of rent. You'll need assets in the bank. You'll need a lot of firepower to go into your file for compensating factors to get that loan done.
Gotcha. And, because in those situations, I imagine there's not a lot of people wanting to sign up to take on that risk. And with credit, what's the floor? Is 400 the absolute bottom score?
No, I believe they go to 350. It's 350 to 850 is where the credit scores go. The range is from. And very seldom do we see them that low. I mean, but you'd be surprised how many folks in the fours will call you up and still think they can get a mortgage. The thing is, we would never want to discourage anybody from trying. And if we can't get it done now, we will refer you out to some of our wonderful credit restoration folks that I work with personally to help you get where you need to be. People just have to be willing to put in the effort to get that done.
So your individual that's just out of college, never taken on any debt, never had any bills in his or her name, do they start off at a 350, or if you have or do you kind of have a
no credit score?
Okay,
if they've never had any credit in their lifetime, they're going to start out with no credit score. So what needs to happen from a young age like if parents out there listening with your kids, this is going to be some of the best advice that you'll ever hear come out of my mouth. I don't care how old your kid is. If you've got a credit card that you keep a low balance on, that you make payments on every month, make your child an authorized user. Okay. You don't have to give them a credit card. They don't even have to know about it. But what you're going to be doing is building their credit up over their lifetime. So that way, to Justin's point, when they get out of college or they start college, whatever they need to do, if they need to buy a car, if they need to buy a house, they're going to have a credit score established. That is parenting 101 in finance world. And I really wish that was more of a commonly known theme. But to your point, if somebody doesn't have any credit throughout their lifetime, they've always paid cash, or they've never applied for anything like that, they're going to have no credit score. We have to at least have one credit score showing on the credit report for us to be able to complete a mortgage for you.
Does the child have to be a certain age to be an authorized user on the card?
That's specific to the credit card company or whoever. But my understanding is you can put a kid on there at any age.
Yeah.
I mean, I could put Luke on mine right now, which I very well may soon.
Yeah, I've seen situations happen in the civil and criminal world where you'll have a parent applies for a credit card in their child's name, but instead of doing it to boost their credit down the road, they do it to gain access to funds because they've maxed out every card they have. And, I've seen folks, and I've seen it happen where, the other parent gets very upset, and, it's a criminal act to do that. But at the same time, I mean, some of these people are 4 or 5 years old.
But here's the thing, though. But by me adding my son Luke, who's 3, that doesn't gain me extra access to credit.
No. I'm just talking about if a credit card's going to issue a card in the name, not as an authorized user, but open an account in a 4 or 5 year old child's name.
That's not what No. We're on the same page.
Yeah.
No, what I'm suggesting is completely above board. In other words, you're the parent. You're in complete control. If you're applying for your own credit card, I think you have to be 18 anyway, or something like that. But as far as being an authorized user, I could add my 3-year-old son any time to any of my accounts, just as an authorized user. That ultimately, and is he going to go apply for credit for 15 years? No, he's not. But what my goal is to wait until he's around 10 years old, then add him on to something where it's really going to start to make an impact. And by the time, like to your point, by the time they're out of school, they've got a good credit score. They should have anyway, if dad's done what he's supposed to do. And also too, just like I said, it helps them as starting out with a fresh slate, as opposed to trying to build credit all of a sudden out of nowhere.
What measure, you mentioned credit restoration. What measures can folks take to improve their credit?
So what we do, what I do with the Lynn with Ben Mortgage team, what we do is every client that isn't up to snub with credit, or we can't get them approved in the system because of credit hiccups, what we do is we automatically run through what's called a what if credit score simulator. Now we do that through our credit vendor that we utilize to pull the 3 bureau scores. Reason we use a credit vendor as like a middleman is because a lot of times we'll have to order subordinations, or not subordinate, pardon me, we'll have to order subordinations, or what am I looking for here? We'll have to update accounts, in essence. There's a word that's escaping my mind right now. It's been a long day. But we have to order, for instance, updated account balances, or if you've paid something off, we have to order it through them. We can't go directly to Equifax, TransUnion, Experian every time. So we use them to go to all three to take care of that. So when we look at the what if simulator, a lot of times if I show that a client pays down a credit card to a certain limit to balance ratio, typically 30% or below, that'll increase their score of 20, 30 points. Or if they pay off a collection, it'll increase their score X amount of dollars. Now, one thing about collections is this: you got to be real careful, because sometimes paying off a collection will actually drop your score initially.
How can that be?
Don't ask me that. Justin, that's a question I cannot answer. Yeah. I think it absolutely defies common sense. It's ridiculous. You're trying to do the right thing to pay something off.
Is the credit?
It's almost like an admission of guilt.
Yeah. Is the credit score formula a matter of public consumption? Like, can you find out how it's scored, or is it? I know you see simulators, because I've got some credit cards, and they come with these. Look up your FICO score or things from the bank, and it's always different every single one. Or you go on.
They use a different formula for theirs than you're going to find with a true mortgage credit report. The mortgage one is the end all hear all, and very often they'll align pretty similarly with some of those trackers, like Chase has a credit journey, Capital One has Credit Wise or whatnot. Credit Karma, I can tell you right now, you better be ready for about a 30, 40 point, 20 point difference.
Does it run high or low?
It just depends.
Yeah,
I've seen it do both. Yeah, it's crazy. Like, there's no method to the madness. I've seen it do both. But I mean, if here's the deal: if you've got A1 credit, I mean, typically if Credit Karma's telling you you're 740 or 760. You typically are, because you've been paying your bills off. You've got your balances nice and low. It's so important to keep those limited balances on credit cards low, and not having them revolve more monthly. That's a big key. But to your question about credit restoration, if I can't get them up to where they need to be through the what if simulator, then what I do is I refer them out to. Can I give an example of the company I refer them to? And this isn't a plug or anything, but I mean, I use Sam Parker with mycreditguy.com. The guy's in Arizona, but he was referred to me by a nationwide group of mortgage lenders. And I've worked with them personally for a while, and they do a fantastic job. What they'll do with credit restoration, they'll actually pull your credit, okay? They'll get your permission to do that. They'll have you sign up for a credit monitoring service that they don't profit from. This is an outside company. It costs like $20, $30 a month to be able to get basically track everything credit-wise, so you can stay on top of it. You get immediate alerts, all that kind of thing. What they do is, when they pull your credit and they analyze it, they see if you're a good fit for their program, and they give you a projection on how high they'll be able to increase your score. So that way you're not just blowing money to pay them monthly on something that's not going to get your score where you need to be. But they know specifically you're applying for a mortgage. They know what they need to target. And you asked about how low a credit score can be. 500 for FHA and a lot of government products. USDA 640 is typically the median, but they will go down to 620 with compensating factors on USDA financing. Conventional financing, 620 is it. They will not go below 620.
Well, and so you say conventional. So I've always understood conventional to mean that's the bank lending its own money.
Well, a conventional mortgage is like you go off agency guidelines like Fannie Mae and Freddie Mac, which are.
And that kind of relates back to my original question about what is a mortgage, because I was thinking, because I've heard people talk about these guidelines and Freddie and Fannie and all these acronyms. But if I'm a bank and I want to lend somebody, or if I want to give a home loan, why does it matter what these guidelines say if I'm trying to lend my own money to people?
Because ultimately you have to follow the agency guidelines to make sure that the loan is sellable on the secondary market.
I got you.
Fannie and Freddie do purchase loans. I mean, they do service a lot of their own loans, but they are the guideline. They are the agency and it's currently being ran by the government right now.
So they're saying, so if you're a lender, you can lend to people with the 350 if you want, but if you have any intention of selling the loan on the secondary market, you need to make sure you're in compliance with the guidelines.
You've got to, or else your loan is worthless. I mean, who's going to buy paper with a 350 credit score? I mean, nobody in their right mind, nobody running the right mind is going to lend money on that.
And what are Fannie and Freddie?
So Fannie and Freddie are the governing bodies pretty much of the conventional agency guidelines and overseeing. They basically set the rules and the policies of mortgage lending. Now, they've talked about privatizing or moving away from kind of government control. Fannie and Freddie had to be bailed out with everybody else during the crises. So the federal government has actually ran them. And the federal government, when COVID hit, when all the mortgage-backed securities were basically worthless. I mean, government loans were worth nothing, literally nothing. Conventional was barely worth anything. The government stepped in and purchased trillions of dollars of mortgage-backed securities to help the market out. And so essentially, the government kind of does run the show, so to speak, on it right now. But eventually, those will be sold and hopefully be in a profitable position. But I mean, Fannie and Freddie are the governing bodies that set the rules for, hey, here's what we need from a W-2 from like a W-2 salary wage earner. We need their pay. We need 2 most recent pay stubs. Their 2 years most recent W-2s, 2 months of assets, copy of their driver's license. They set the guidelines in that respect. And investors, what they'll do, they'll underwrite off agency guidelines and sell direct to Fannie and Freddie at some points because Fannie and Freddie are big servicers. Yeah. They'll have sub-servicers collecting the payment once again. But what'll happen is if I am selling right out the gate the mortgage I do for you, Justin, to Wells Fargo. I package it up nice and neat for them. They're oftentimes they're investor overlays. Wells Fargo is even going to pad those guidelines. So if Fannie says we'll go up to 49.9% debt to income and you can get it approved eligible, Wells Fargo may say, well, we're going to minimize our risk. We're not going to take it above 45%. You see my point? Yeah. So there's so many different moving parts.
So you don't have you just can't get it over 49. But if you are over, but you can make it more stringent if you like. But
for conventional financing, 49.9% is the absolute cap, and it used to be less than that for Freddie. I mean, pardon me, Fannie Mae. Fannie Mae used to cap it at 45. Freddie's gone 49.9% for a long time. Now with government financing, with FHA. I've gotten people approved with the right circumstances up to 56, 57% debt to income because their credit was worthy or they had a bunch of assets or what have you. VA doesn't go off debt to income at all. VA goes off residual income. And USDA is very tight. They're a 29% front end ratio, which is your housing ratio on your debt to income. The back end is capped at 41%, which is your cumulative debt to income ratio. So you have the front end is the housing, back end is the cumulative. Yeah. But USDA to saying that it's typically capped at 29.41. If you have compensating factors, they will go up to 32, 33% front end. 43, 44% on the back end, but it's very, very tight.
So I guess you've got the HUD determines the guidelines, I guess, for FHA and VA and some of these. Then you got Fannie and Freddie, which are essentially government agencies are regulating the conventional market.
They're government agencies because of the mismanagement of the money in this country. That's why. I mean,
because the government's had to bail them out since they're so heavily invested into it.
Exactly.
Gotcha.
Which makes you wonder if somehow some of this stuff isn't just a perfect plan. You know what I mean? It all seems to fall into their hands. Now loans like FHA, VA, USDA that are government loans, insured or guaranteed. They're fantastic products, and they help a lot. Billions of people get in their homes. I mean, they're just great. They're great for folks, especially with bumps in the road in credit. And if for an active military personnel or veteran, they're great with an 800 credit score, just as they would be with a 620. Yeah. But there's really not a whole lot of overlay on the interest rates on those. And so when we talk about Fannie Freddie, yes, do they need to be privatized? I believe they do. I mean, it'd be nice if there was another body besides the government running it, but the government isn't giving them their money. I mean, they're supposed to be profitable on their own and things like that, but the government has had to bail them out.
Well, the final topic I wanted to get into today is mortgage insurance, and kind of from a fundamental aspect of what is it. So is that the way I understand it is the lender is insured against the borrower's default. Is that how mortgage insurance works?
Well, basically, yes. So mortgage insurance is set up. If you don't put down 20% on, say, a conventional mortgage, then you're required to pay mortgage insurance, all right? And what the mortgage insurance company does is the mortgage insurance company is insuring insurance against you defaulting on that loan. So if, God forbid, something happens where somebody did and they foreclose, the mortgage insurance company is going to pay the lender back a certain spread amount of the money that they've loaned. So it is essentially you're paying as the consumer for insurance that you are going to make your payment. I mean, that's the thing with mortgage insurance.
Does it protect the payments, or does it protect a shortfall in the foreclosure?
I mean, it doesn't. My understanding is not so much the payments as it is the shortfall in the foreclosure. They help out. They help they help the mortgage company against that. It's not a payment by payment type thing. Now there could be something set up on the servicing line, Justin, that I don't know about, where they do help out with payments or something like that. But my understanding is that is not the way it is. That would get tacked on at the end with a payoff amount if they had to have a short sale or foreclosure.
Now, who sets the rates for mortgage insurance? Is this Freddie and Fannie?
No, Fannie and Freddie don't have anything to do with that. You've got like 5 major players in the mortgage insurance game. You've got Genworth, you've got Radian, you've got Arch. And I'm trying to think of a couple other. I could go. The list goes on and on. But there's about 5 major players in the game of mortgage insurance. So what we do is when we are quoting out interest rates, we price out the loan after we've got it set up. We pull your credit, of course, prior to this. The factors that mortgage insurance is going to look for is credit score, debt to income, and loan to value. Okay. So what we do is we actually plug it into our systems, and it'll populate the mortgage insurance carrier's rates based on the loan application specific scenario. So as an example, today I ran mortgage insurance on a gentleman that's buying a $500,000 home. He's putting down 5%, so his loan amount's going to be $475. His credit score is of 743. Guy's impeccable. I mean, just a great borrower. But this gentleman's mortgage insurance rate on a 30-year fix was going to be 0.47% of the loan amount, which equated to, I think it was $173 a month. All right. Now, mortgage insurance, if you do, being that there's no prepayment penalty on any of our mortgages, if you do decide that you want to pay the mortgage down after you initially buy in at, say, 5% down, you owe 95% loan to value. If you did want to put down 15% more throughout the process, you can get that mortgage insurance removed. It's very important for folks to understand. On a 30-year amortization on conventional financing, if you put down 5%, you're probably looking at 10, 11 years if you just make every payment on time before that mortgage insurance is going to fall off. On FHA financing, the mortgage insurance never goes away. Even if you put down 20% on an FHA loan, you're going to have mortgage insurance. Now, that used to not be that way. In 2013, Congress decided they need to refill the coffers of FHA to help beef it up, and they made mortgage insurance a lifetime thing. There is a House Resolution Bill 3141 that I've been advocating for very strongly. Can't seem to get anybody to take it up because they're wasting their time doing whatever mess they want to do up there in Washington. To get this passed to remove the mortgage insurance off FHA if somebody puts down 20% or if they've paid in to 78% loan to value, have it removed like it used to be. But in 2013, they changed all that. VA financing has no mortgage insurance, which is a huge advantage to the veteran or active military personnel. 100% financing with no MI. USDA financing, the mortgage insurance rate is always at 0.35% monthly. So you borrow $100,000, it's $35 a month. FHA is always 0.85% monthly. So if you borrow $100,000, it's $85 a month. Unless you put down 5%, then it goes to 0.80.
Last topic I want to get to, and it sparked in my head because you mentioned the gentleman you worked with that was taking on the $500,000 loan. Mm-hmm. What's the deal with jumbo mortgages? What's the distinction between why does that matter if a loan's a jumbo versus a standard loan?
So Fannie and Freddie have said conforming, which is a conventional loan is a conforming loan. A jumbo loan is what's called a non-conforming, which means you're not conforming to agency guidelines if you're non-conforming. And Fannie and Freddie have raised the caps over the years. When I first started in the business, I think that the cap for cap for conforming financing was $425,000. They have since increased it in our market to $510,400.
That's interesting because and that makes sense because $517,000 gets you a fantastic home out here. Maybe in San Francisco, not so much.
Right. So out in California, you're going to be looking at like a jumbo limit of like 736 or 700,000. It depends on where your geography is in the country. Here in Wilmington, North Carolina, here where we're at, you're looking at 510,400. So here's the thing: if folks want to, if say the house is priced at 550, you just be prepared to bring it down to a $510,400 loan amount. Now the interest rates are better going conventional than they are jumbo. Jumbo in a lot of cases. See, jumbo went away when COVID came. Jumbo was gone. I had to call some people that were locked in on jumbo loans and tell them, I'm sorry, I can't honor your rate. We no longer offer the product. You talk about horrible phone calls that to make,
Oh,
Justin.
yeah.
It was terrible. So anyway, yeah, to your point, that anything above $510,400 is a jumbo loan. The interest rates are typically a little bit higher.
The region set up for that. Is that like, is Wilmington different from Elizabethtown, or is it just they say North Carolina is 510?
It's going to be 510,400 in the entire state of North Carolina. Yeah, it's really segmented, I think, more of like an East Coast, middle of the pack, West Coast type geography. But in New York, obviously, they get more leverage there. But they go off, they look at adjusted median income. They look at a lot of different factors to try to figure out what that number needs to be. But I mean, I know if I'm going to do a loan here, if I'm going to do a loan in Asheville, the conforming loan limit's 510,400.
Do you do loans across the state?
Absolutely. Yeah, absolutely. I'm licensed in 4 states: Kentucky, South Carolina, Florida, and of course North Carolina, and we do it across the state.
Is the bulk of your business local in the Wilmington area?
Absolutely. The bulk of it is. I'm from Kentucky, so I carry that license, and a lot of folks here and in Kentucky like to buy homes in Florida, to vacation or whatever. I mean, heck, we live in a beach town. We have a wonderful vacation here. But anyway, yeah. So do it across the board.
How do you go about marketing yourselves in some of these other states where you don't have an active presence?
Really, it's just referral based. I don't do a lot of marketing in those other outlets because I have so much here. We have so much business here that we're very grateful for, and that's not being braggadocious. That's just to say I don't really need to market in those other areas. I just keep the license in case my clients need me to venture out in those markets.
Understood. Well, I appreciate you coming on. I know you've given us a lot of time today, and I know how busy you are, so that means a lot to me. It's been very informative for me. I hope the people listening have enjoyed it. Can you tell everybody where to reach you?
Hey, it's Ben Hawkins. You can tune in to the Lynn with Ben show every Saturday morning from 9 to 10 on 106.7 FM, The Big Talker. You can also reach me at my website at lynnwithben.com or on my personal cell. Feel free to give me a call off the air at 910-352-3373. We know the best real estate attorney in town to connect you with on your purchase or refinance transaction. That's the Humphreys Law Firm.
Well, I appreciate that, and I appreciate you coming on. And everybody, I'll see you next Thursday, 6 to 7, and we'll talk a little bit about some construction law.
That's awesome. Thanks, Justin.
Thanks.